Hello students, today in this lesson we are going to discuss an exercise for revaluation account. Revaluation account and partners current account, capital account. Okay, revaluation account is like this, right? Today the exercise is we will discuss one exercise on revaluation account, right? Uh, the exercise number one says partnership accounts revaluation of assets. Sorry, A and B are the partners sharing profits and losses in the ratio is to 7 is to 3, right? 7 is to 3, A and B sharing the profits and loss, right? And the following was the balance as on 31st March 2020, right? They have given the balance sheet, right? Here they will give balance sheet only. Okay, so on the above date the assets and liabilities are to be revalued as follows. On the above date the assets and liabilities are to be revalued as follows. One, asset depreciate machinery at 5%. Right. What is the value of depreciation? What you call this? Machinery is 30,000. Machinery value is 30,000. Our in the 30,000 they says depreciate the machinery at the rate of 10%. 10% in the sense if it is 30%, 30,000, 3,000. 3,000 we have to credit the machinery account, debit the revaluation account, right? To machinery account, right? Machinery account 3,000 revaluation account, debit, right? And credited to the machinery account, right? If you have the machinery account you had to credit it to the machinery account. Say machinery, here machinery, right? Machinery account, brought forward balance. What is the brought forward balance is 30,000. So we are crediting the 3,000 as revaluation account. Then carrying value is 27,000. Sorry, carrying value is 27,000. Okay, only the 27,000 will appear after revaluation account transfer. That is the double entry. Okay, understood. And second adjustment is stock to be depreciated at the rate of 5%. Stocks is 20,000. Stocks 20,000. See, stocks 20,000, right? It has to be depreciated at the rate of 5%. 5% in the sense 1,000 rupees has to be credited, right? 1,000 rupees has to be credited. Revaluation account, stocks. Decrease in assets, right? 1,000. Create a provision for bad debts at the rate of 5%. Debtors, what is the debtors value is 30,000. Debtors value is 30,000, right? Sorry, debtors value is 30,000. This is 19,000 carried down value, right? 20,000, and here is brought down value is 19,000. Right? 19,000. The value of the stocks has decreased 20,000 to 19,000. Machinery has decreased from the 30,000 to 27,000. The difference is charged to revaluation account. Okay. And other thing they say is bad debts. Debtors. Debtors. Brought forward balance is 30,000. Debtors brought forward balance is 30,000. Right. In the adjustment they says provide 5% for provision. Provision 5% means 1,500. 1,500. That has to be transferred to the revaluation account. Revaluation account. Then carried down value will be 28,500 of the debtors. Okay. Brought forward 28,500. Right? 28,500. Then here we will say provision for debts. Bad debts. Provision for bad debts. How much? 1,500. 1,500. Right? 1,500. Okay. So we have done that. And next adjustment they says the value of buildings to be appreciated. The value of building appreciated to by 20%. Right? Building account. Right? Buildings account. Building account. Right? Buildings account. Brought forward balance would be how much? 40,000. Brought forward is 40,000. This is building account. Buildings are to be appreciated by 20%. The value of normally assets are depreciated, right? Assets are depreciation, but buildings and land will appreciate. The buildings are depreciated, but land is appreciated. Land will be always appreciates. Value will appreciate. Right? Here they says buildings and land and building is appreciated by 20%. Okay, 20% in the sense it is appreciated by 8,000. 8,000. 10% is 4,000, 20% is 8,000. Then this will go to the revaluation account. Sorry, appreciated account. Then this will go to the revaluation account. Because the value has increased. Right? Here, buildings value will show carried down value 48,000. Right? 48,000. This is 48,000. This is brought forward will be 48,000. Right? 48,000. So it is appreciated by 8,000. So when you make an entry building account debited, here it will credit 8,000 to building. Buildings account. Right? And last adjustment is creditors are to be increased by 10,000 rupees. Creditors are to be increased by 1,000. Already creditors are 26,000. Right? Creditors balance. Creditors brought forward how much? 25,000. Creditors are 25,000 brought forward. Right? It has to be increased value. Revaluation account 1,000. Right? This not forward is 26,000. So revaluation account going to be has to be debited by 1,000. That is the creditors. Increased in creditors. Right? Increased by 1,000. This is the last adjustment. 1, 2, 3, 4, 5. Five adjustments. 1, 2, 3, 4, 5 adjustments we have done. For all the adjustments, I have given the T accounts for you to understand. You are not in the preliminary stage. You know the debits and credits. What is the double entry for current assets and liabilities? You know, right? You know the double entry for the provision for bad debts and bad debtors written off, right? So depreciation, you know what is the double entry. Prepayments, you know. So again, I am not going to explain you those things. Right now, we come to the matters only. Right. Then capital account A and B. How much? Brought forward balance. Brought forward balance. Capital account is 80 and 40,000. 80,000 and 40,000. Right. Here we will get the profits only. Profits transferred to capital account. Right. A and B. This is you are going to calculate. Balance it. Right. While we are balancing this, right, we have to see whether we can do the balance sheet also. If you do the balance sheet extra, you think you can understand what we are doing. I will do the balance sheet on T format, right? Non current assets, right? Current assets, equity, non current liabilities, current liabilities, equities, right? Non current assets, another non current assets, what we will have, right? right? On current assets, buildings, machinery, furniture and fitting. Right? Here we will balance this one, right? 8,000. Revaluation is 8,000. Here it is 8,000, right? What is the difference? 500, right? 500, 1, 4, 5, 6, 7, 8, right? 500, 4, 5, 6, 7, 8, 1,500. 1,500 has to be apportioned 7 is to 3. Right? 1,500 divided by 10 into 7. 1,050 is 1,050, B is 450, right? So, right, divided by 7 into 3, 450, right? So, this is the profit, but we have to transfer to capital account, profits. Revaluation, profits, right? A how much? 1,050. 1,050. A is 1,050. B is 450. Right? B is 450. What is the balance? Right? 40,450. This one is 81,050. Right? Here we say 81,050. 81,050 and 40,450 and 121,500. 121,500, right? Here we will take from here buildings 48,000, right? Buildings 48,000, right? Machinery, creditors, creditors how much? 26,000. 26,000. Right? Machinery how much? 27,000. 27,000 machinery. Right? Stocks. STOCK. Stocks how much? 19,000. Right? 19,000. Right? Debtors how much? Debtors 28,500. Cash and bank how much? See, cash and bank 25,000. 25,000. Right? Furniture and fitting fixtures 15,000. Right? How much this? Right? 15, 20 to 6, 8, 90,000. Right? This is how much? 500. Right? And 17, 22. 72,500. 72,500, 162,500. It will come around 162,500. Right? The creditors, we'll say creditors and bills payable 15,000. Bills payable 15,000. Then 1,000, 41,000. Right? 41,000. 162,500. 500, 2,000, 162,000. It is balancing. Balance sheet also balancing. Finished. Okay. So for this question, we have done the revaluation account, partners capital account, and T accounts for the relevant adjustments, and we have completed the balance sheet also. Balance sheet also balance. Okay. Good. Right. So with this, I think you would have understood what is the revaluation account. The revaluation surplus. This is revaluation surplus. It's shared by the partners. Right. So the double entry is there. If you say recap is, I'm coming to the recap. They say depreciation 10%, buildings, machinery depreciation 10%. This is the brought forward value is 30,000. If you are saying depreciation, then the amount has to be reduced, right? So depreciating value is going to reduce by 3,000. So assets balance is going to reduce by the asset account credit, revaluation account debited. Instead of going and debiting to the depreciation account, you are debiting to the revaluation account. Right here also, building when the building value is appreciating by 20% for the buildings, the building accounts debit and credited to the revaluation account. Here we have credited. Other entry comes to revaluation account. For the debtors also, you are making a provision for bad debts 1,500. Then debtors account you are crediting by 1,500, but you had to debit it to the revaluation account by 1,500, saying that provision for bad debts. So that is the matter. Rather than you are putting here debtors, you can say provision for bad debts. Right? Provision for bad debts. Provision for bad debts. So debtors 30,000. Provision for bad debts. Provision for bad debts. Bad debts. Right? During the year we have made 1,005. Revaluation. Provision for bad debts 1,500. Right? This will be the same. Right? Right. So here under the debtors we have to show 30,000 minus 1,500 as provision. Provision for bad debts. Right. So 28,500. Then 28,000. Carried value is provision. Credit. Debit. This is debit. Debited. Like that. Creditors also, the value of the creditors, they says increase by 1,000. So there is a increase in the creditors. Then 26,000. When increases, creditors account credit and debited to the revaluation account. So double entry, you must be familiar with the double entry, right? Here the accounts only the difference. Format of accounts is different. Okay. So I hope you would have understood this question. In next session, we will talk about the valuation of goodwill. Valuation of goodwill at the time of admitting the new partner, right? I think you got it, and if you have any questions, you can correspond to me, and we will meet in next session. Okay, thank you. Bye.